Okay, good morning. Good morning and welcome to this morning's keynote address. I'm Ali Naqvi, Head of Equities for Asia Pacific at Credit Suisse. It's my great pleasure to introduce to you this morning Dr. Charles Evans, President and Chief Executive Officer of the Federal Reserve Bank of Chicago. In this capacity, he participates in the Federal Open Market Committee, the FOMC. He's an alternate member of the FOMC during 2014. Dr. Evans joins us this morning to discuss an issue that is not only of fundamental importance to the US, but to markets and investors everywhere. What direction does US economy policy need to take in order to achieve the goals? So he's going to especially focus on financial stability and monetary policy, the two things which obviously we want to hear more about. And what tools will the Federal Reserve use to help it successfully guide the economic growth of the US economy, and what will this mean for the Asian economies and obviously for investors as well? Dr. Evans is best positioned to discuss these topics given his extensive experience in the FOMC and also his academic background. He has been president of the Chicago Fed since 2007. He previously served as a director of research and senior vice president, supervising the bank's research on monetary policy, banking, financial markets, and regional economic conditions. Prior to that, Dr. Evans was a vice president and senior economist with the responsibility for the economics research group. Dr. Evans has also taught at the University of Chicago, the University of Michigan, and the University of South Carolina. He received a bachelor's degree in economics from the University of Virginia and a doctorate in economics from Carnegie Mellon University. His well-published personal research has focused on measuring the effects of monetary policy on US economy, inflation, and financial market prices. At such an important juncture for the US economy, it's a great honor to have Dr. Charles Evans with us today. Please join me in welcoming him to the AIC.
Thank you. Thank you very much. Thank you, Ali. Thank you very much. It's a pleasure to be here today at the Credit Suisse Asian Investment Conference, and thanks to the organizers for inviting me. It's a very impressive program. Pleased to participate. Today, I would like to make 3 points concerning the U.S. economy and accommodated monetary policy. First, the U.S. economy continues to improve, and accommodated monetary policy will remain a strong support for this recovery for quite some time. Second, although highly accommodated monetary policy can lead to increasing inflation risks today, inflation in the U.S. is very low. And this is true throughout much of the world. Third, while low interest rates could lead to financial exuberance in principle, monetary policy is not the best tool to mitigate this risk. Instead, macroprudential policies are more appropriate tools to address the risk of financial instability. Before turning to the details of these 3 points, I need to note that, as always, the standard Fed disclaimer applies. My colleague, Jim Bullard from the St. Louis Fed, was here yesterday, and I'm sure he said exactly the same thing, which is these are my own views and not those of any of my colleagues in the Federal Reserve System. As you all know, in response to the unusual economic circumstances generated by the financial crisis and the Great Recession, the FOMC lowered our traditional policy tool, the target federal funds rate, to near zero levels in December 2008 and has kept it there since. With the federal funds rate constrained at this lower bound and economic conditions requiring additional policy accommodation, the committee also deployed non-traditional policy tools to stimulate economic activity. We embarked upon large-scale purchases of long-term Treasury securities and agency mortgage-backed securities. We also used new communication tools to provide forward guidance about how long policy interest rates will essentially remain at their lower bound of zero. While large-scale asset purchases and forward guidance are unconventional tools, their effect on interest rates and real economic activity is quite conventional. Both tools are aimed at stimulating economic activity through lower long-term interest rates. Through arbitrage and portfolio rebalancing, Lower rates in one market are transmitted to other interest rates faced by investors, non-financial firms, and consumers. Lower rates are also transmitted across the asset and maturity spectrum. There's significant evidence that the FOMC's policies have been helpful in reducing rates of financing costs paid by firms and consumers, and more generally in supporting aggregate demand in the face of substantial economic headwinds over the past 6 years. It should be noted that economic activity picked up momentum in the second half of 2013. Overall, real gross domestic product grew at about 3.25% in the second half. Actually, it was revised up just yesterday. It's almost 3.5%, up from an average pace of growth of about 2% over the previous 3 years. Moreover, we've seen more solid consumer spending, which should provide further impetus to overall growth this year. In the labor market, job growth has been solid, and the unemployment rate is down to 6.7%. That's well below the 8.1% rate that prevailed when we began the latest round of large-scale asset purchases back in September 2012, the so-called QE3 program. However, frankly, we're not out of the woods yet. The harsh weather of this past winter makes the recent data difficult to interpret. And here I'm talking about the so-called North American polar vortex, something of which you're not at all aware of in this lovely climate. I've been gone for about a week, and my wife tells me that it snowed the other day in Chicago. It's March, late March. All of this said, some of the data have been on the soft side. Balance sheet scars from the financial crisis are still weighing on the U.S. economy. Fiscal policy is a restraint on economic growth, and economic activity around the world is not robust enough. The good news is that all of these headwinds appear to be dissipating, but risks remain. And we still have large resource gaps. For example, the unemployment rate is still well above the 5.25% rate I think it should be in the longer run in the U.S. At the same time, inflation is only 1%, well below the FOMC's longer run target of 2%. Accordingly, monetary policy is highly accommodative today and needs to remain so for some time. Given these developments, the FOMC began adjusting the mix of its tools in December. The committee, however, is maintaining the overall highly accommodative stance of policy. The committee modestly reduced the pace of its monthly asset purchases from $85 billion now down to $55 billion per month in 3 separate $10 billion steps. In addition, with the unemployment rate approaching the 6.5% threshold that was established in December 2012, the FOMC decided it was time to update its forward guidance on the future path of short-term interest rates. Our policy statement now emphasizes that when deciding how long policy rates will remain at their current level, the committee will use a wide range of information to assess the realized and expected progress toward our dual mandate goals of maximum employment and price stability. The statement also indicates that given the committee's current assessment of these factors, it likely will be appropriate to keep the Fed funds rate at its current level for a considerable period after the asset purchase program ends. Furthermore, even after the economy lifts off and employment and inflation are near their mandate-consistent levels, economic conditions likely will warrant keeping short-term rates below their typical long-run level for some time. What this means is that the path of the federal funds rate increase will be shallower than normal. The various asset purchases the Fed has undertaken since 2008 have expanded our balance sheet more than fourfold to over $4 trillion. Moreover, according to the FOMC's projections and the latest market expectations, by the time the policy rate increases, it will have been near zero for about 7 years. These are startling facts and should certainly get everyone's attention. As prudent policymakers, we would be remiss, in fact, we would be AWOL if we failed to carefully assess potential risks that might arise from these unusual and extraordinary policies. As the FOMC's communications indicate, The committee has fully reviewed the potential costs of its policies, and it reassesses these costs regularly. I think that the benefits of our policy choices continue to far outweigh the potential risks. However, we must repeatedly think long and hard about two risks that are mentioned often, namely that our expanded balance sheet and the prolonged period of low rates raise the risk of higher inflation and also the risk of financial instability. What can go wrong? Do we have the appropriate infrastructure and tools to adequately assess and manage these risks? To address these questions, we must evaluate these risks and within the context of the goals of monetary policy and the current state of the economy and financial markets. We just have to constantly be evaluating them. So let me start with the risk of high inflation. As far back as mid-2009, Fed critics warned that our near-zero policy rate and trillions of dollars in asset purchases risk generating very high inflation. On several occasions to underscore this risk, I've been presented with a gift of a Zimbabwe $100 trillion note. Now, as someone who's associated with the US government and the guidelines restricting the presentation of gifts, there's a $20 limit on these gifts. I can assure you that this is less than $20. The monetary policy mandates of the Federal Reserve are clear. We must foster monetary and financial conditions that support maximum employment and price stability. Since January 2012, the Fed has set an explicit goal for inflation of 2%, as measured by the price index for total personal consumption expenditures, or PCE. So, how are we doing with respect to this 2% target and our Zimbabwean risks? Despite many earlier predictions of unacceptably high inflation, total PCE inflation has been hovering around just 1% since early 2013. Other inflation measures, notably the well-known Consumer Price Index, are also well below their related benchmarks. Forecasters often look at core inflation, which excludes volatile food and energy prices in the United States, because it's a better predictor of where overall prices are headed. Our progress toward the inflation target is not noticeably faster by this metric either. Core PCE inflation was just 1.1% over the past year and has been at this rate since last spring. Most private sector forecasts and survey measures of inflation expectations have remained well anchored and do not ring any alarms of high inflation. Expectations embedded in asset prices tell a similar story. Sophisticated financial models that extract inflation expectations from the yield curve show that investors' inflation expectations at the 3-year ahead horizon are still below 2% and will be below 2% for several years to come at a 3-year horizon, rolling. All told, the risk of high inflation seems very low. In fact, I'm concerned that inflation will not pick up quickly enough. As I noted, we've been stuck at 1% inflation since early 2013, and there's little indication of a pickup in the recent data. Low inflation is just as economically costly as high inflation. When we set an inflation target at 2%, we need to hit our target without too much delay. Simply put, we need to average 2% inflation over the medium term. Accordingly, the current 1% inflation situation calls for extended policy accommodation. If the Fed embarked prematurely on more restrictive monetary policy conditions, these adverse actions would work to reduce inflation to further unacceptably low levels. That's certainly what our theory would tell us. That's going in the wrong direction. Now, it's easy and most natural for a Fed policymaker to talk about inflation. Price stability is one of the explicit goals of monetary policy as mandated by the US Congress. Financial stability risks are more complicated. How does financial stability dovetail with the Fed's dual mandate to support maximum employment and price stability? There's clearly an interdependent relationship between them. A strong economy with low inflation provides a key stabilizing force for beneficial credit intermediation and robust financial market functioning. At the same time, stable and well-functioning financial markets are essential for achieving maximum employment and price stability. The global experience since 2008 reinforces this critical interplay between monetary and financial conditions. However, beyond these basic principles, what's the appropriate monetary policy stance for achieving both financial stability and our dual mandate of maximum employment and price stability? With inflation running well below our 2% longer run target and the unemployment rate still well above its normal long-term level, appropriate monetary policy dictates that low real interest rates should prevail until the economy is further along a sustainable path to its potential level and inflation is closer to target. Nonetheless, it is common to hear the argument that these highly accommodated monetary policies might sow the seeds of financial instability. The fear is that excessive and persistently low interest rates would lead to excessive risk-taking by some investors. For instance, some firms, such as life insurance companies and pension funds, are under pressure to meet a stream of fixed liabilities incurred when interest rates were higher. And perhaps these liabilities were offered at somewhat generous terms to begin with. To meet commitments like these in the current low interest rate environment, some firms have an incentive to reach for yield by investing in excessively risky assets. Furthermore, with the costs of borrowing at historically low levels, other investors might simply decide this is a good time to cheaply amplify the risk and return in their portfolios by taking on more leverage. One could reach the conclusion that historically low and stable interest rates pose a threat to financial stability. This creates a seeming paradox for policymakers. On the one hand, the existing large shortfalls in aggregate demand call for highly accommodated monetary policies and historically low interest rates to generate stronger growth. But on the other hand, such policies have the potential to raise the likelihood of financial instability in the future. So the questions that I'm often asked regarding these matters are like the following. Do the regulators and the Fed have adequate safeguards in place to mitigate this potential financial risk? If not, should the FOMC step away from what we thought was the best monetary policy with respect to our dual mandate? Should we discard our non-conventional tools and raise the Fed funds rate in order to reduce the possibility of undesirable financial imbalances in the future? I don't believe that such monetary policy adjustment is the right approach. I think the inference that persistently low interest rates pose a danger to financial stability is based on a narrow view of the economy. This narrow view is unlikely to survive a broader analysis that takes into account all the interactions between financial markets and real economic activity. If more restrictive monetary policies were pursued to generate higher interest rates, they would likely result in higher unemployment and a sharp decline in asset prices, choking the moderate recovery. Such an adverse economic outcome is unlikely to set a favorable foundation for financial stability. Moreover, our short-term interest rate tools are too blunt to have a significant effect only on those pockets of the financial system that are most prone to inappropriate risk-taking. At the same time, these blunt tools could significantly damage other markets, as well as the growth prospects for the economy as a whole. Therefore, stepping away from otherwise appropriate monetary policy to address potential financial instability risks would degrade progress toward maximum employment and price stability. This approach would be a particularly poor choice when other tools are available at lower social costs to address the risk of financial instability. So let me be clear. I'm not saying that financial stability concerns are not relevant for the economy, or that policymakers should not take decisive action against developments that threaten financial stability. Rather, I am saying that the macroprudential tools available to policymakers are better suited safeguards for addressing financial risk directly. These macroprudential actions can be dialed up or down given the appropriate setting of monetary policy tools. So undesirable macroeconomic outcomes are less likely than if we were to resort to premature monetary tightening. Indeed, any decision to instead rely on more restrictive interest rate policies to achieve financial stability at the expense of poorer macroeconomic outcomes must pass the cost-benefit test. And such a test would have to clearly illustrate that the adverse economic outcomes from more restrictive interest rate policies would be better and more acceptable to society than the outcomes that can be achieved by using enhanced supervisory tools alone to address financial stability risks. I've yet to see this argued convincingly, frankly. Now let me discuss some of these macroprudential tools briefly. One simple but important tool is enhanced monitoring. Even before the recent financial crisis, central bankers were well aware of the key role played by stable financial markets in economic activity. Since the crisis, however, the analysis of financial stability issues has been greatly expanded and given a more prominent role in the FOMC's deliberations. We comb through reams of data looking for evidence of incipient risks to financial stability. The Federal Reserve also has revamped its approach to bank supervision substantially to expand the focus on macro financial risks. Traditional bank supervisory tools are being used more intensively, and new tools have been developed. Bank capital stress tests are one well-known addition to our supervisory toolkit. Another is the augmentation of traditional microprudential supervisory work that analyzes individual institutions with efforts that take a wide-angle view of the banking industry. Supervisors look to identify common trends across institutions and emerging concentrations of risks that might pose systemic threats to the financial system. This broad view also allows supervisors to better identify sound practices among firms and incorporate them into supervisory reviews and the feedback provided in them. The Federal Reserve also has greatly expanded its surveillance efforts to financial markets outside of the traditional banking sector, such as the insurance industry and financial market utilities. These efforts are not confined to financial institutions per se and reach a range of activities that might pose a potential threat to financial stability. For instance, staff members from the Chicago Federal Reserve Bank are actively engaged in assessing the role of high-frequency, computerized trading in securities and derivatives markets and associated risks that might arise with it. These are just a few examples of regulatory tools available to monitor and promote financial stability. And there are a host of other instruments in our toolkit, such as resolution plans, liquidity requirements, and single counterparty credit limits. All are examples of improvements in supervisory practices aimed at reducing the likelihood of systemic disruptions and containing the impact should such disruptions occur. Okay, so let me begin my concluding observations. To reiterate, I currently expect that low inflation and still high unemployment will mean that the short-term policy rate will remain near zero well into 2015. In this environment, some have questioned the ability of our supervisory and regulatory tools to adequately address potential financial instability risks. They argue that a broad tightening of interest rate policy might be more effective in catching incipient risks that might fall through the cracks. It's certainly true that higher interest rates would permeate the entire financial system. But this is just another way of saying that raising interest rates is using a blunt tool. Higher interest rates would reduce risk-taking where it's excessive, but they also would result in a pullback in economic activity in sectors where risk-taking might already be overly restrained. That's how a blunt tool works. If you believe that financial stability can only be achieved through higher interest rates that would do immediate damage to meeting our dual mandate goals at a time when unemployment is still unacceptably high, then we ought to at least ask ourselves if the financial system has become too big and too complex. Think about how problematic the cost-benefit calculus becomes if the only way we can achieve financial stability is to raise interest rates above the level where the forces of demand and supply in the real economy put them. The possible benefit of such a restrictive rate move would be to reduce risks that might be forming in the nooks and crannies of a highly complex financial system. But the cost would be higher unemployment, a risk of choking off the economic recovery, even lower inflation below our objective. We're at 1% right now. And somewhat paradoxically, the introduction of new financial risks by reducing asset values and credit quality. Given such cost-benefit trade-offs, I would have to question whether the financial system has become too complex, perhaps complex enough to generate negative social value. Rather than degrading our macroeconomic performance through suboptimal monetary policies, I would have to consider whether we should contemplate big changes to the financial system. A lot more rules, substantially higher capital requirements for all institutions, and maybe even fewer financial products. However, I have a more favorable view of the social value of our financial system and the efficacy of supervision and regulation. Since the financial crisis, the Federal Reserve has expanded its macroprudential toolkit and enhanced its microprudential tools. We have also reoriented our approach to supervision to take full advantage of the Federal Reserve System's wide-ranging expertise on macroeconomic and financial development and risks. I believe that these regulatory efforts can effectively minimize the risks of another crisis and increase the resiliency of the financial system. We can achieve these objectives without having to resort to wholesale changes to the financial system and without degrading our monetary policy goals. Maintaining the effectiveness of the financial system for generating more robust economic growth continues to be a crucial objective for public policy. Thanks for your attention, and I look forward to your questions.
Thank you. Dr. Evans, thank you very much. I think it's, for us based in Asia, somebody from the US advocating low interest rates actually is good news, not bad news. So we support that view. If I can start, we'll take now questions from the audience as well. But if I can start, I think you touched on two things, obviously on the low interest rate side, but also you touched a little bit about, we can do more changes into the financial system as well. Would you like to elaborate on that a little bit more? What type of changes you can think of so that we can manage the risk from that side?
Well, I think that, in the U.S., we've embarked upon a lot of changes in our regulatory environment. The Dodd-Frank Act obviously was a big change. It gave the Fed enhanced supervisory responsibilities along with other agencies as well. We created the Financial Stability Oversight Committee headed by the Treasury Secretary so that we could bring all the regulators together and to address the most important systemic issues that we face in financial markets. I think this just means that we need to continually work with all of our international regulatory partners, the Basel process, and just understand the financial risks that we all might be facing that much more clearly. We obviously, in the U.S., we obviously had a lot of difficulties with our exuberant housing policies, high housing prices, and frankly, we didn't appreciate how much leverage was embedded in so many financial products in the shadow banking system in the United States. We also probably didn't have enough surveillance authority and information about that, and so we're trying to ramp that up. What we want to do is get the economy on a much better footing so that all financial institutions, the banks in particular, have good, strong levels of capital, higher quality capital than they had before, so that we can enhance the credit intermediation process that's so important for continued capital investment. That's where we need to be headed.
Okay. Any questions? Take care first.
We hear a lot about hawks and doves on the board of the FOMC. How wide a disparity is there, the differences of opinion that go on? Is it as wide as we see in the press, or is it a more narrow difference?
Well, the information is there for everybody to assess for themselves. I mean, I'm out here talking about the need for highly accommodated monetary policy. I have many excellent collaborators who I know very well on the committee who give speeches and they come to other conclusions where assess the risks and sort of push different viewpoints. That's what the committee process under Chairman Bernanke and now Chair Yellen is meant to take advantage of. Chairman Bernanke at one point was asked, is he bothered by committee members who dissent? I don't think anybody ever likes dissents, but he sort of said, it's important for everybody to express their opinion. If everybody's just repeating what I'm thinking, I'm not getting more information. I'm just getting back what I'm saying. So there's a lot of commentary. We're extraordinarily transparent. We put our speeches out on the web. We come to events like this. I've been on panels with a number of my counterparts who are associated with more hawkish behavior, and we explain ourselves, and hopefully the public and financial markets understand what we're trying to accomplish, what we have shared consensus about in terms of achieving our policy goals, and that we're going to get there as quickly as we can. But I certainly understand that if you're listening to a variety of, well, I was on a panel in New York just a few weeks ago, and Martin Wolf was the moderator, and I got up and spoke with some comments like this, and my colleague from Philadelphia, Charlie Plosser, got up and made some comments as well. We're very friendly towards each other. Martin Wolf said, geez, I'm surprised that two people who hold such different views can work together on the committee. But we do, and we worked on the communications subcommittee with Vice Chair Yellen at the time also, very productively. So I hope that helps.
Okay, there's two questions there in the front. Here, yeah.
Thank you for your talk. I've had a great central bank week. There have been several central bankers we've listened to, including one former one from Europe. And the thing that I'm trying to get a handle on is that would you agree that we haven't seen any negative side effects yet of the unconventional policy? Would you have expected to see them 5 years into this? And even you, when you said $4 trillion, you were almost wowed by that number yourself.
Sure.
And so, is it surprising that we haven't, well, what side effects do you think we've seen of that, unintended side effects, you might say, of that policy? And just sort of, it's following up on the last question, what is the intellectual framework behind, let's say, the European approach, which is really very much against that, both on a treaty basis and also on a factual basis? I mean, the ECB balance sheet just shrinks every week while the Fed balance sheet continues to expand. Obviously, they don't want to not help their economy on purpose. What is the thinking there about not doing unconventional things in their economies, arguably in worse shape than the U.S. economy?
So we've certainly embarked upon unconventional monetary policies for quite some time. I mentioned that we're many years into a period where we've had zero interest rates in the U.S. It's just unavoidable. That's appropriate policy today because the unemployment rate was almost 10%. Inflation today is 1%. If it were within our capability to set interest rates at negative levels, if we weren't stuck with the zero lower bound, we would have reduced to negative territory short-term interest rates. That would have been the normal response. A Taylor rule that ignores that indicates that we would have been at minus 5 percentage points back in 2009. That's not available to us, and so we had to start thinking very differently. Chairman Bernanke was an innovator and an expert on 1930s monetary policies and also financial industry developments in macroeconomic theory. He put together a number of innovative liquidity programs which helped out with the fact that our credit intermediation process was broken back in 2009. So that's been very important. In that time period, because there's been so much risk aversion on the part of financial investors, because consumers in the U.S. have had such a large debt overhang, whether it be from mortgages or credit card debt, in a world where there's great employment risk and high unemployment, they haven't been able to sustain higher consumption. So we've just been in this very slow recovery, and we haven't been able to get out of it. So in the U.S., especially with inflation at 1%, it becomes, I don't see how it's objectionable that we have very accommodative monetary policies. But of course, that does put pressure on financial markets. We've reduced spreads. Risky spreads are down quite a lot, and you can become very nervous that there's too much leverage. We all know that if too much leverage gets embedded in financial markets and you end up doing silly investments knowing that you can get out before markets change, you think you can get out, well, you can't always get out. The door gets very narrow and everybody wants to get through. So very mindful of that. We look at a lot of these markets. One that we worried about, we noticed, was agency reinvestment, the REIT market. There's a lot of leverage embedded there, and when the taper tantrum last year took place and term premium went up 100 basis points in the treasury markets, that market got crushed, and that leverage is now gone. What's important is that what we look for is systemic implications from these markets. If when I look at a financial market and I go, oh my God, the price is high. Oh my gosh, it shouldn't be that high. Should it? I don't know. I might have that opinion about all kinds of markets. I start worrying that people are going to take losses. That's not my job. Investors are to take risks, to allocate capital to their most efficient uses. It doesn't always work out, but they're big boys and girls, and that's what they're there. If you make a lot of money for good investments, that's great. And if you lose, well, you tried or whatnot. But if I have to start having an opinion about every investment, I'm going to get it wrong, and we don't need that. So we need to get the economy growing, get everything on a better footing. That includes getting inflation up to our target, because a lot of people, if there's debt overhang, if you've got a mortgage and it's a fixed interest rate in the U.S., it's based upon an interest rate that thinks that we're going to hit our inflation objective. Well, that's a percentage point relative to where we are today. That's a burden on them. In the same way that if we have 4% inflation and interest rates assumed it was going to be 2%, that's a burden on lenders because they get killed in that sense. We just need to even that out, and we're looking for that. In terms of the Europeans, I think that we all are facing the same theories in terms of how our economies work. I think it's unobjectionable for central banks that when you say you're supposed to hit 2% and you're well below that, you need to get up to that. And I think everybody's thinking about that now. If they haven't been thinking about it before, everybody's thinking about it now. That's appropriate.
Okay, we had another question there. Just here.
Sort of a follow-up to the previous question. One of the criticisms of QE is that each successive version is less effective, and all it does is build up the $4 trillion of debt. If you can comment on that, and that also, of course, implies there's no more utility in another QE if that was necessary.
That's a fair point. I think that there are, probably diminishing returns to increasing sizes of QE, especially when the economy starts to turn and is doing better. Less is needed, and so we have to think about that. In the U.S., 10-year Treasury rates got to be so low at 1.66 in March of 2013. There is no estimate of the effectiveness of our programs that suggests that Fed policy was responsible for getting 10-year Treasury rates all the way down to 1.66. The effectiveness of our programs at their maximum is measured in something like 20 basis points for $500 billion of asset purchases. But we were down to 1.66. Something else was afoot, and part of it is the signaling effect of what our policies intended. So here, I think we were very effective and successful. In fall of 2012, we undertook policies, and we basically were trying to get across the message, we're going to do what it takes. We're going to keep at it. We're going to continue to do this until we see substantial improvement in labor market outcomes. And that was different than QE2, where we said, we're going to do $600 billion. We're going to assess whether or not that's the right number. But 600 got embedded, and that was the expectation. It was effective, but the open-endedness, I think, indicated we really intend to meet our mandate objectives. That's really the number one task for communications, whether it's a 6.5% explicit threshold, or whether it's a qualitative statement that we're going to look at indicators and we're going to keep the funds rate at 0 until we see something, or whether or not it's going to be, well, we expect that when we do take off, it's going to be shallow. All of those are useful communications phrases, but the number one most important thing for the public to understand is we're going to do what it takes to get to our inflation objective and the economy back to the growth path that gets us to the sustainable level of unemployment. And when they understand that and we follow through, good things happen.
Question in the middle here. Yeah. I'll just come back to you then.
Given the globalization of the financial world, I think you must be aware the impact to emerging markets or Asia economy given FAC's policy. Yeah. Understand that being a U.S. policymaker, your main objective is not to concern other countries. But given the globalization, your policy actually will affect other economy that will ultimately affect U.S. economy as well. So when you are making your decision, how you value or how you give a consideration on that effect. Thank you.
Right, so I take those concerns very seriously. It's certainly the case that U.S. monetary policy, what happens in the U.S. has an effect on the rest of the world economy. We're a large economy. There are other large economies that have large effects on the world economy as well, and the emerging market economies are increasingly important. We would be better off in the U.S. if emerging market economies were strong, healthy, and the European and Japanese economies as well. That's what we're looking for. I go back to the late 90s, the Asian financial crisis, and it was just very helpful when the U.S. had a strong economy. The American consumer stepped up, probably consumed more than their income prospects really warranted at the time, but they provided more of a lift for the entire world economy, and that was beneficial. So when we pursue accommodative monetary policies to get the U.S. economy going, I think that benefits emerging market economies. What's really important is not that we have an inconsistent monetary policy approach that sort of jerks everybody around and injects unneeded, unhelpful volatility in financial markets. And so I understand that last year when we started talking about tapering QE, that wasn't fully expected at that point in financial markets, and that led to volatility that was difficult for everybody. And it was difficult in the U.S. I think that slowed things down a little bit in the summer for the U.S. as well. So that's why I say it's most important that we go out and say, we in the U.S., we're going to be paying attention to the world because it affects us, but we want to make sure that the U.S. economy is as strong as possible so that it can provide a help to everybody else to the extent that we have good relationships, economically speaking, and we'll be better off. And we want to be very transparent. I think that what we're conveying in our most recent policy statement, Chair Yellen's press conference, and the commentary that we're all giving right now, it should be clearer to everyone that we're going to continue with policy accommodation for really a considerable time. I personally doubt that the funds rate is going to start to increase before the middle of 2015. I think it ought to increase later than that. If I had my druthers, I'd think that's appropriate policy. But even if it does, I think that it's going to be a shallow path, and it's the entire policy path that matters. If we go out and pound that message out to everybody repeatedly, I think that gives every economy a chance to get their own house in order, to deal with a better financial situation, and we'll all grow together. But that's very important.
Okay.
Over the last 20 years, U.S. core inflation has been about 1.7%.
Sorry, which has?
U.S. core inflation, core PC, has been about 1.7% over the last 20 years. Now, part of it, low inflation, is due to structural factors such as technology, globalization, lack of labor pricing power. How realistic is it that monetary policy can get you to an average 2% inflation in the current setting?
Oh, I see. So I'm not sure about the average that you're talking about. The PCE number, well, at any rate, I think it's been higher. I know it was higher in the 3 years prior to 2008. It was over 2%, and we've had periods where it's been higher. But that's not the important part. So you're pointing out that within the basket of goods that get priced in the index, there's emphasis on technology, electronics, things where productivity has been very strong, and the cost structure has been such that those price increases have been low. In fact, you've had negative price movements in a lot of high technology goods, electronics, and all of that. And that's all fine. That's all microeconomics. That's efficient allocation of resources among industries and things like that. At the macroeconomic level, what monetary policy is supposed to be dealing with, monetary economics, we get to pick the inflation rate. The technology is not going to dictate what inflation's going to be, because we're going to print more money or we're going to print less money. We're going to have more restrictive policies or we're going to have more accommodative policies. So if some composition of the basket indicates that it's going to be 0.5 percentage point on inflation, we need more accommodation just so that all prices on average go up by more, and the average is 2%. That's what central banks do when they're doing their job right. If technology all of a sudden, I mean, think about it. If technology, was degrading and all of a sudden prices were, being dictated to increase at 5%, would the central bank just accept that? No, they wouldn't. They'd undertake more restrictive policies so that average inflation would be closer to their target. The 1970s were an example of that, when regulatory factors and higher energy prices plus monetary policy led to higher inflation. It's the same on the downside too. So that's why we need more accommodation. We need to get it up to 2%. Once we get to 2%, then we can have more normal policy and it'll go back to things we're more familiar with.
Okay, possibly 2 questions more. Let's get it here first. Sorry.
Thank you for your speech. I have a question. I'm wondering, can you comment on the non-monetary economic policy that is needed in the U.S.? I mean, we focused on monetary policy, but in your opinion, can you comment on other?
Do you have a particular area in mind?
Labor or productivity, other fundamentals that can determine the long-term economic trend growth of U.S. Thank you.
I could probably talk for an hour on all the different issues that the U.S. economy is facing. I might have thought you were inquiring about fiscal policy. Labor developments have been very interesting in the U.S. In the U.S., we have a variety of demographic factors at work which have led people who have previously been active in the labor force to withdraw from the labor force. Now, at a time where we've had very slow economic growth, my first worry is, are people leaving the workforce because they're discouraged? That could be an issue, that could be an indicator that there's even more slack out there than just what the unemployment rate indicates. But in fact, the research and the setting in the US is that the demographics are such, the population's aging in the US, aging around the world, and now people are moving out of the workforce, they're retiring or choosing not to enter market activities. And that's led to reductions in the labor force. That's going to have implications for how the economy grows over time, depending on growth in the labor force. That's an important determinant for growth. I think that some of the reductions have, in fact, been cyclical. And so when the economy begins to pick up, I think that that's going to be an indicator that they'll come back into the market a little bit. But that's one of the issues. Another issue in the labor market is that there's a changing return to skills in the U.S. and everywhere. There's more of a return to people with high skills, technology skills and things like that. And if you had a nice middle-class lifestyle in the U.S. in the 1950s, you might have been able to be part of the middle class with only a high school education and have a good income level. And now today, with world competition and the change in skills, that's a much dicier proposition and very difficult. So the entire reward mechanism is changing, and the workforce has to adjust with that as well. We also have fiscal policy issues to deal with, but I think I'll leave it at that.
Okay, sure. There's one at the back there.
Yeah, you talked about the perceived risk of unconventional monetary policy. Do you think one of the main risks of this policy is precisely the exit strategy itself? Given the fact that we are in uncharted territory, do you think the risk of a policy mistake is higher in this situation? We had obviously an example what happened spring last year with a taper tantrum. What is your take on this and on the exit strategy and the risk of the markets maybe interpreting differently your actions?
Right. Okay, let me give you an example of a scenario that I think you're probably getting at. So we have a very large balance sheet. We have a zero interest rate policy environment. And what if the circumstances were to change so that we needed a more restrictive monetary policy? What if it happened more quickly? I said there's likely to be a very slow increase. What if all of a sudden we needed it to be much more restrictive? Well, our balance sheet is so large, it would be very difficult for us to put pressure on reserves in a way to make financial matters more restrictive. So that's an interesting risk. We need to think about that. What are the circumstances? We need to think about the circumstances that would dictate that, because it's not just any circumstance. So let me give you an example. Suppose inflation started to increase. Suppose that it was on the basis of our large balance sheet. Well, how's that going to happen? Well, banks have a lot of reserves out there, and they're not really putting them to work. Not putting them to work because the loan demand's not really that high. Businesses don't need to expand, and corporations already have a lot of cash themselves, so they don't need loans. But what if banks all of a sudden started making a lot of loans, and they would be putting those reserves to use? Now the money multiplier would be a lot higher, and we know from the way we've always thought about it, that's likely to be inflationary. What are the implications? I'd throw a party. I'd be happy, because you know what? When banks are making a lot of loans, that means economic activity is going to be a lot stronger. They're not just going to make loans, handing them out for gambling and things like that, but it's going to be for productive investment activities. The economy would be stronger. Unemployment would be falling. That's exactly the circumstances where we would very cheerfully start withdrawing even more quickly from our accommodative policies. If we needed to put more pressure on our large reserves, we have the ability to do it through reverse repos. We've tested that market. We can do it on an overnight basis. We've tested that market actively. We've got a term deposit facility. There are ways that we can sterilize the effects of our large balance sheet, and we're still likely to just allow our MBS holdings to roll off as they mature. If we had to sell the assets prematurely, we'd take a capital loss. That would be difficult. That's the kind of thing that you'd be really nervous about. I would be too. But it's going to depend on the circumstances. And if it's in an environment where the economy is strong, we're going to be able to weather that. If it's in an environment where people wake up one day and think inflation is going to be 4%, that would be challenging, but I'm having a hard time understanding how that survives, especially in a world economy which has so many challenges. And even if the U.S. has a lot of challenges, the entire world economy has so many more that it's relatively not as bad. So I think you have to think through the different scenarios to really put some meat on that.
Okay. I know there are more questions. I'm afraid we have run out of time here. So please join me in actually thanking Dr. Charles for very questions.
Thank you.